Hello and welcome. For today's interaction, I'm joined by my colleague Chirag, and we have with us Neelesh Surana, CIO at Mirae Asset Investment Managers. Welcome, Neelesh. Great to have you here.
Yeah, hi, Ruchira and team at Value Research. Thanks for inviting me.
Thanks. Now, you started with an engineering background and later pursued an MBA in finance. Could you please share what sparked this shift and how did you embark on your journey in the financial world?
I think the interest towards stock markets started during the college days, along with engineering, and during the while CCI days, was participating in various IPOs, and it sort of coincided with the famous Rashad Mehta bull run. And there were some eureka moments in terms of a couple of cases where you invested, and then it's actually turned out to be a 10x or 20x in few months. And of course, that fascination led to sort of changing gears towards this profession and pursued MBA and then uh, 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 came to Mumbai in terms of joining sell side research part. And after being for about 7 years on the sell side, move on the buy side on the PMS role. And in 2008, I moved to Mirae Asset, and which was a sort of startup sort of experience. And that's how the journey sort of continued. Yeah.
Mr. Surana, reflecting on the last 3 decades, the equity markets have undergone substantial changes. From your perspective, what are the most striking differences between the market then and now?
Yeah, I would say that, I mean, over the last 2, 3 decades, I think what has changed, there's no more significant information arbitrage. I mean, a lot of information data is now available uh, publicly to everyone, all sort of investors. Earlier, the institutionalization both of sell side, buy side was not as much. And with the regulator and with quarterly results and with a lot of information today, you get it literally. In fact, you get more than what is required sort of information. So that is one sort of change over the since liberalization or so. And that's when we had FIIs coming in. And as I said, both sell side as well buy side has got much more sort of institutionalized. Beyond that, I think uh, the overall underlying trend of stock markets and price value differentiation, greed, fear, cycles, I think that has not sort of changed much. It's probably the information arbitrage has reduced, and which could have probably led to some sort of dilution of analysis or analytical arbitrage, if I were to use that word. But that said, as I said, the core of stock markets, sort of volatility and opportunities, that has not sort of changed here.
Right now, you started your career with IL&FS Investments and then moved on to Ask Investment Managers. So, how was it working alongside Bharat Shah at Ask Investment Managers? It must have been an enriching experience. Can you please tell us how was it working with him and also the kind of impact it had on your career?
Yeah, so I mean, it was excellent sort of learning and under Mr. Bharat Shah and the rigor of research, etc., and how to the lens to look at growth-oriented businesses obviously evolved. A lot of learnings there. And by the way, he is among the few investors who sort of articulates also exceptionally. And his articulation probably shows the correct path to investing. So that obviously helped in filling gaps in terms of whatever learning, which is the task of daily sort of process in our profession.
Sir, you were also, before joining ASK, you were also part of IL&FS Investments. So how was it like being on a sell side while being at IL&FS Investment Managers?
So Chirag, sell side is by and large same in the sense like you have a set of sector which would have coverage of about 15, 20 stocks. And institutional sell side, there is a particular rhythm in terms of you have to work. And I think the depth of coverage has to be models, etc., has to be much more in depth. But the width of coverage is not much. So it does help at an early stage. And of course, then there are associated things in terms of you have to talk on the buy side and you get a perspective, but it's limited to a couple of sectors.
So what were the key learnings during that time, which has helped you in your career going forward?
Yeah, as I said, I mean, there are pros and cons. I mean, on the sell side, you need to spend a lot of time in terms of writing also. And there is the hygiene or the maintenance part of the work is quite intense. Every quarter, you have to write reviews. So those, it takes a lot of time, and same set of companies you have to review. So as I said, it increases the overall depth of coverage of those sort of stocks. But it is, as I said, it would want to take a very broader spectrum of companies on to track, then obviously it has its limitations. That is one of the reasons that after some time, many people, and including me, probably also sort of decided to move to buy side to expand the horizon in terms of coverage.
Right now, talking about you moving to the buy side, you've been at Mirae Asset as a startup, and it's been 16 years now. So, can you please share what's so special about this place that helped you stick around for so long?
So I guess, I mean, I would say that the uh, the uh, the core foundation led by our promoters and the local management board, CEO, etc., has been is on more on the longer term, looking at the longer term lens, looking at investor first sort of approach. As at the same time, knowing that the foundation of this business, one of the important factor is investment in research and the team and the investment team. So I think it probably sort of aligns well with individual goals and sort of values. So that's one of the reasons. And the second, I would say in general that in this profession, there is a constant sort of pressure to perform with peers. It's challenging as well as exciting. And a task to assume investors, I mean, trusteeship of investors' wealth and compound is satisfying. But given this aspect of the profession, it's better that someone sticks with a single organization for longer term to have personal aspiration of more longer term track record built in. Lastly, I would say that over time, I mean, we have, like many organizations, much more institutionalized. So the softer aspects also sort of help you on continuity. I mean, the softer aspects about working with the team and how they are working passionately, hard work, and the teamwork. I mean, that also helps you mitigate the sort of challenges of the profession and continue with the existing phase.
Mr. Surana, next thing, just wanted to understand, you started, Mirae Asset started in 2008. There were some, at that point of time, there were some crises due to the global financial meltdown in the markets. And later on, your funds became a blockbuster in your later on from 2010, 11 kind of thing. So, what will you attribute this success to, the blockbuster performance of funds after during that particular time?
Chirag, first of all, it's not one individual. As I said, there is a back end of a dozen member team. Now it's almost 18 member team. So yes, you are right that post when we started from a industry perspective, there were a lot of headwinds for 5, 6 years post the global crisis. But from an investment team perspective, we just followed a particular template of both stock selection and portfolio construction, which helps us actually delivering decent relative returns both over the benchmark and the peers for at least for the first 14 years. Last couple of years have been slightly challenging. I'm sure you would probably cover it, but from a longer term lens, even now, if you look from a rolling 5 year basis, we have a fairly satisfactory track record. So what helped is more teams sort of contribution in terms of both stock selection and portfolio construction. And that disciplined approach helped us through the cycle. And when the tide turned, as you recollect, I mean, the tide turns in terms of the flows, post the global crisis actually turned in only in 2013-14. And this business, one of the pillars is performance. Of course, it's to be supported by sales support and relationship, etc. But when the tide turned, we got a fair degree of market share based on the first 5 years and then first 7 years and 10, 15 years sort of track record. Lastly, I think I would just sort of to add that we should not underemphasize the tailwind for this sector. We are in the 16th year, and equity AUMs for the size has gone by 10x in this period. So we are part of the tailwinds. I mean, many other fund houses also done well.
Now, coming to your investment philosophy, how would you describe it? And are there any specific stocks or specific types of stocks or market situations that particularly grab your attention? If you could cite some anecdotes there, that would be great.
Yeah, so the investment philosophy, very quickly, Chira, if I had to say the house sort of template, we can bifurcate into two pieces. What is the stock selection philosophy, the do's and don'ts, where we invest, where we don't invest. And second is on the portfolio construction, because the mandate is to outperform the benchmarks. So on the first, I would say that we believe that you pick up good quality businesses and hold it for an extended period of time. And there are some subcomponent of which needs to be analyzed or filters to be put in, which is related to the business analysis, related to the management analysis, and lastly, in terms of what price you are paying, which is the valuation part. So on the business front, it is essentially equities is about growth. So we have some basic filters that the business should have, let's say double-digit growth, ideally low sort of growth, higher the better. And the quality of growth as defined by return on capital employed should also be value accretive. So we have an internal benchmark of around 14-15% return on capital employed as a minimum filter. On the management part, you can't put a quantitative filter, but I think a lot of emphasis is given in terms of analysis of the management, both on the basic hygiene part in terms of forensic analysis and getting from peers and balance sheets and past capital allocation, etc. But more importantly, I think we give a lot of emphasis on the thought leadership part of it. So first is the corporate governance and the hygiene part. Second is that in order to capitalize on the business states, which is growth and ROCs, the differentiation within a sector among companies, one of the central thread is how is the management in terms of its that thought leadership, that capital allocation, their passion, their zeal to excel in that thing. And I mean, all businesses, all companies goes through hardship, how they come out of it. So all these aspects are taken. And lastly, so stock selection is, we have very well-defined models in terms of what we track, and we assign a value based on long-term DCF. And idea is to buy at a discount. So the price, the value gap has to be there. So that's a long answer, but on the stock selection, on the portfolio construction, I think it's a discipline and adequate diversification is important. And as I'd mentioned, that the mandate is to outperform the benchmark. So no sector, stock, style, theme should deviate significantly from the underlying constituents of the benchmark. So generally, our active share at sector level is not very high. I mean, all this put together, I mean, I would say idea is on a stock selection not to buy cheap companies, but to buy good companies at a reasonable price and construct a risk-adjusted portfolio from a longer-term lens. To your the part what excite or what differentiate, I think not for the sake of differential, but I would say that we have not shied away from taking some contrarian opportunities when good businesses sort of pass through a bad patch. I would say the patch where near-term prospects are hazy or impaired, but longer-term is intact. I mean, be it stock specific, if I were to give certain timestamp example over the last 15, 16 years, I mean, let's say auto major, there were a lot of issues in 2009, 10, strike, fire, etc. And the literally earnings collapsed by a third. I mean, the prices came down. So there's always a double counting in contrarian situation that near term is a bit hazy, but the valuation also comes much more drastically. So that would have bought in oil marketing companies in 2014, 15, or I would say a lot of even government companies 5, 6 years back, some of them. Now pharma companies in between. So we have seen that maybe not in current market. Generally, you see some some sectors going through a rough patch, and or some companies going through a rough patch. And as I said, those gives them, in our opinion, one helps us take a longer term view. Second, you get a higher margin of safety. So I think that sort of excite not only me, but in fact most of my team members, and we don't shy away from taking those opportunities.
Sir, next thing, when evaluating the potential investments, what makes a stock stand out to you as a must buy? Sir, I'm asking, for instance, you have one of the private bank in your portfolio, which remains a top holding in both of the schemes which you manage, despite being a underperformance for a long period of time. So, what's the rationale behind such decisions?
Yeah, Chirag. So one is like what happens is when we look at top 10, I mean, we don't get the full color of the portfolio. If you look at, let's say, our banking exposure, there would be mix of some of the names which have done exceedingly well, including the largest public sector bank, a few public sector banks, or some other companies in that. So even a private bank. So it should be seen in the portfolio construct. But to your question, without going in the specific name, I would say that it's probably ties up with the answer which I mentioned earlier, that these are good franchise, sustainable businesses. Longer term is intact, but there are near term challenges in this case because of certain issues related to an entity being merged and some challenges which are known. But in our opinion, it's not that the 3-5 year view, both in terms of growth, all the factors which I mentioned, growth, ROE, management is sort of intact. And in fact, the valuation, because it has underperformed, has become cheaper. You are right that what makes you, let's say, hold. So all these things that certain stocks are not working for a couple of years is only at hindsight, right? Some of the stocks do work, but generally they coincide with earnings revival. So here is a case where there is obviously a longer term approach. And, as I said, it's probably one of the cases where still it falls in that contrarian sort of bucket. Long term is intact, but near term is challenging. And we are longer term sort of investors. Lastly, Chirag, again, we have to look at, when we look at certain specific names, we need to look at both the construct of the sector, which are the stocks we own. At the same time, we have to look at the active weight. So the weight of the stock in the portfolio minus the benchmark weight is what we are looking at. In this case, the active weight is about 1% or 1.5%, something like that. It's less than 2%. But the benchmark weight itself is high. That's why it does appear, obviously, as on the top holdings.
Sir, to that question only, so in terms of stock selection, when evaluating the potential investment, what makes a stock stand out to you and as a must buy?
No, I mentioned that the house template, the what makes it ideally stand out is outlier in those four factors, which is uh, the business growth is very high, let's say mid to high teens. ROCs are very high, let's say again high teens or 20 or 25% plus. North of that, theoretically, it can be higher also. Exceptional management, and lastly, very cheap valuation. Normally, you don't get all the combination, but theoretically, this is where a stock or an opportunity gets sort of exciting. As I said, in a normalized market, you may not get all the combination because if everything is going right, then the valuation may not be good. But you get opportunities. Some contrarian opportunities could happen. Some market-related opportunities. Let's say what recently COVID threw. Over the last 15 years, I can say there are many macro things which led to market corrections, etc. That time you may get valuation, and you have to keep the bucket list of the first three criteria ready. And when you get valuation in favor in terms of price value gap, then that sort of ticks the boxes in terms of meeting the investment framework for the as I said, overall our own sort of investment.
So, sir, typically bear markets excites you more than the bull market in terms of stock selection.
Absolutely not me, but it's like basically money is made investing in bear market, all else being same, because that's where you get dollar for 50 cents or lower or so. So, and in a normalized market, you will compound. There won't be any P mean reversion. you will compound at the rate of earnings. So it's not that India is a longer term secular market. So it's not that only in bear market you will make money. But yes, in a downtick, particularly if it is not, it's more market linked or if it is more external linked and it is more near term, then as you say that it's literally a bit of sale, right? So you margin of safety expands. Margin of safety is value doesn't change as much, but the price is correct because of greed, fear, multiple factors. And by the way, higher the margin of safety, lower the risk and higher returns. So that's the sort of classic case, which we have also experienced post global crisis, multiple events.
Moving to the Mirae Large and Midcap Fund and the ELSS Tax Saver Fund, the last couple of years have been tough. Can you please share with us what were the main hurdles and how do you plan to steer these funds back to their winning ways?
Yeah, Ruchira, just to sort of recap, the large and mid-cap fund, the nomenclature change, it was called earlier Emerging Blue Chip Fund. I'm a co-manager, and Ankit Jain is associated with this for the last 5 years.
Mhm.
And to your question, one is even now, because the fund has a 14-year track record on a 5-year ruling basis since inception, it's been fairly decent. But yeah, performance over the last couple of years have been soft, particularly last 18 months. And the reason for that has been, see, in this thing, you always have some errors of omission and commission. So I would say that it's more to do with errors of omission, where we have been probably conservative in some of the opportunities, and they were mostly related to the industrials and the capex and those sort of space where we were slightly under index. But we have few names, but the weights were less, and that is one segment which has literally gone from very cheap to reasonable to some cases bit expensive on a short. So on that's on the errors of sort of more on the mission or bit of conservatism for avoiding that, frankly. And at the same time, certain sectors which we own, let's say the mass market consumer discretionary, except for autos, have not sort of done well or so, or maybe a couple of banks, which was Chirag was mentioning, that probably would have not sort of done well. How would we sort of, to your question, try to handle such situation is it's whether the performance is an end result, the back end remains the same in terms of seeing the construct of the portfolio. In this case, there were under indexed to industrial, so that's a bit of learning. So we're trying to see if there is an opportunity, but would not sort of chase it. But if there is an opportunity in that sort of space, we were under index. It's not that we were not having names in that. And at the same time, sort of doubling down on some of the positions which have corrected and time corrected and makes sort of sense in a risk adjusted manner. So I think what happens, Ruchira, is the overall, if you look at the construct of the portfolio over the last 14 years in the large and mid cap and 8 years in the tax or other funds also, the construct has not changed and the philosophy has not sort of changed. It is a combination of few omission errors and commission error which have come together in an environment where value moved very significantly, high value stocks. So it's a part of journey and it's part of learning. And as I said, the back end is to just sort of strengthen and see where we can fill in on these sectors which are sort of under indexed.
Sir, if we look at the large and mid-cap and ELSS funds, they share a significant overlap in the top holdings. So just wanted to understand, is this strategic or a reflective of the current market conditions and opportunities?
So Chirag, one is the fund managers are same, right? Number one. Number two is if you look at the benchmark, the construct of larger companies is similar, right? Because the large cap portion of large and mid cap will have a percentage holdings is quite sort of high. So there will be commonality of name, particularly in top 10, 15 teams. If there is a similar manager and the benchmark is not very sort of differentiated. And mid caps and small cap, which is more in the large and mid cap space, in the mid cap fund, the erstwhile emerging. If you see the portfolio between the next 20, let's say 21st to 40th stock, or 15 to next 25 stocks, will be more different to the tax saver compared to the top holdings. Lastly, as I said, if an idea is good, if the benchmarks is same, then weights may be slightly different. So all these factors are leading to commonality.
So it's more to do with the benchmark only, sir.
No, it's see benchmark is slightly different. I'm saying the top 10 would replicate in terms of names. The weights will be different. If you see
Okay.
it different, the active weights are different. The absolute weights are different because the benchmark is the names are same of the top 10, most of it, but the weights are sort of different. That is one. Fund manager commonality is there. Of course, emerging is also managed. Uh, these are the two factors.
All right, now Mirae Mutual Fund's investment in some of the new age companies is something that has raised eyebrows, especially considering their current financials and challenges. So, how do you justify these investments to your investors, and what's your long-term view on these companies?
Yeah, first of all, see, I'd like to sort of clarify. First of all, it's a very calibrated risk adjusted, say 4-5% exposure across 4-5 names based on individual merit of the stock. That's first point. Second is we don't see it as new age, old age as a industry sector classification. Each is different, and actually each are different businesses.
Mm-hmm.
But yeah, there is some commonality. I mean, in our opinion, many of these companies are dominated by few players and sectors and leading to a oligopolistic or duopolistic market structure, which is one. And I think the businesses ticks the box in terms of longevity of growth, good ROEs, and management at an overall level being sort of decent. They're learning, but they are sort of decent. And most of them have been picked in situations which were slightly not at today's level, but let's say 1 year back, if you recollect, there was a lot of selling in these basket of companies for multiple reasons, including exit of many private equity players, etc. So there was a price sort of value gap. So I think, as I said, we don't classify it as a new age or old age sort of thing. The basic template of stock selection, and it may be a bit surprising, but we use that DCF template even for these. Of course, these businesses cannot be looked at current sort of multiples. So many of them, as I said, would have right to win longevity, good ROE. Valuation was a challenge in 2021-22. Towards the end, we have seen many of the cases correcting towards about a year, 15 months back, and that's when some of them have booked them. And lastly, as I mentioned, you have to look at it in not a particular name, but the portfolio overall. Even if you were to classify it as a particular sort of segment, these will be 4-5% spread across 3-4 names.
Sir, you have been ahead of curve in in choosing the taking a trend or a scenario. So, are you witnessing any big opportunity trend or scenario? What do you think is the next big thing in the markets? Like, for example, AI is there or something else kind of thing?
Chirag, I can talk on many disruption trends which are well known, but that may not be linked with stocks. The reason is what is already doing well. For example, Make in India, defense, many of the sectors which are doing well, or government entities sort of turnaround, etc., may be already priced in. So good businesses, good trend need not be good stocks unless you are at an early cycle stage. So in that context, today's market, I don't see a significant trend which is totally underpriced and yet to be sort of discovered, which to call out any particular name. I think it's more a market where one should just take the longer term secular sort of growth sort of approach. Some near term trends could happen in our opinion, in the mass market consumption sector, which has not done for last 2-3 years. There we see that valuations are reasonable and there could be mean revert. They have price time corrected, so there could be mean reversion in earnings. A couple of very large banks on the private sector. Also, there are some specific issues which longer term, as we talked earlier in the interview, could sort of mean revert. But again, these are not something like a dollar for 20 cents or 50 cents sort of opportunities. Beyond that, I think market is fairly sort of priced, and it will be more about earnings growth and the returns expectation linked to that, rather than identifying something which is totally undiscovered.
Right now, finally, if you had to venture out in fund management today, what would you do differently this time?
No, as I've touched on many points, it's an institutional process. We are now managing almost $19 billion of money. We are seventh largest on active fund management. So what you do different is it's not, I mean, what we were doing 5 years back, 10 years back, we are trying to fine tune those processes. And it's all depend on the foundation is you can do differently, obviously depends on the quality of research that we and fine tuning that, strengthening that, not only in terms of headcounts, but in terms of various processes and how the institution work, how the analysts sort of work. So we have, and it's a journey. So we have fine tuned many processes. We have weeded out what is not required processes, and that's an ongoing process. And of Mirae Asset as an institution, rather than me doing something different. The skills are different, the responsibility is very significant. So it's more an institutional thing, and strengthening of that is what we can do in terms of our efforts, so that you limit the errors of omission and commission. There will always be some mistakes, but you limit the percentage of that, and also construct a portfolio which is risk adjusted, so that you deliver superior risk adjusted performance in the longer term, not by an individual, but by my fund management team.
Thank you for taking time to share your journey and insight with us.
Thanks for inviting me, and it's insightful sort of. It's good talking to you and associated with value research. Thank you very much.